Greetings, everyone. Welcome to the webinar. We're going to wait just a moment while everyone moves from the waiting room into the webinar. So we'll be starting in about half a minute. Okay, I think we'll start. So first of all, welcome. Thank you for joining us today. We're very excited to be talking to you and with you. I want to emphasize that we look forward to your questions throughout the presentation, and we'll answer as best we can. But we'd love to hear your perspective and your questions, and we hope this to be as interactive as possible. We've billed this as a post-election debrief. And the way in which we're going to approach this is to talk about the impact that elections have on your finances and the impacts they don't have. You know, there are some realms in which there's likely to be an impact or could be an impact. And there are some realms where we think that, while presidential elections and congressional elections are important, they're consequential, they don't necessarily impact your finances in the way you might think. So with that, I'm now going to pass it up to Yusuf, and and I should introduce, I'm Dave Yeske, co-founder of Yeske Buie, and I am joined today by Yusuf Abujaderi, our Chief Investment Officer, and Lauren Stansel, our Chief Planning Officer, and they're going to help us cover a lot of territory in the next 30 or 40 minutes. Take it away, Yusuf.
Matt, we will. And before I go through our agenda for the day, Lauren, I think we want to have a quick poll, just checking in with the audience and asking how you're feeling about the overall status, markets, and the economy going into our conversation today. We'll hang out here for a moment, give you all a chance to respond, and thank you all for participating. Lots of answers coming in.
Got about 80% responded. Oh, some good answers coming in quickly. We have a couple others, so feel free, send your answer for other in the chat. You can read it out. All right, I will go ahead and go many of our answers in. I'm going to go ahead and end this poll and share with everyone so you can see how people are feeling.
A mix, as we might have expected coming in, and we'll check in again towards the end of our conversation today and see what, if any, impact what we've shared is having on how you're feeling. So more to come. But in terms of what we'll be discussing today, our agenda includes a few different pieces. We're going to be talking about resilience. If I could get my slide to cooperate here. There we are. Resilience being a part of your plan, not just your portfolio. And so Lauren's going to have a few talking points on that particular topic for us to go over in our next slide. After that, we'll do a performance review and just talk about how the portfolio has been doing year to date over the past several years. And we'll look at a few different trends that we've observed. And we're going to pick on the S&P 500 for a bit. And we have our reasons for wanting to focus on that particular index. Certainly, it's been dominating the headlines for quite some time now. So we'll have a few items to share there. And then we know the results of the election. Donald Trump will be president come next year. And so what does that mean for potential policy implications? What lies ahead? What are we seeing? What are the things that we're thinking about? We'll have a few items to share there. So that's our roadmap for the day. And with that, we'll move into our first slide.
Yeah, so as Dave was sharing when we were getting started, we are not trying to say that the results of the election or elections aren't inconsequential. We know that there are many things that come out of Washington, no matter who is president. And as you may have heard us share in our last webinar in this space earlier this year, the market really doesn't care who's president, and neither does it your financial plan. And so a good friend of mine, a good financial planning friend of mine, I heard him recently sharing with his clients that there's no drop down in your financial plan for who's in the White House, who's in control. And that's because your financial plan includes so many different aspects of your life, of which one piece is who's in control. To repeat myself or ourselves again, if you were in that previous webinar about who's in control of the White House and if the markets care, I used another analogy about making chocolate chip cookies. So if you think about making chocolate chip cookies, whether it's with your kids or your parents or by yourself, whoever you like to make your chocolate chip cookies with, as you're following the recipe, you have your bowl, you're putting in your flour, your sugar, your chocolate chips, hopefully a lot of them, probably some salt in there, certainly some eggs and some baking powder. And when you put it in the bowl, you see all of the ingredients, but then you mix them up, you bake them. And if you don't eat them all right away or in one bite, you break one in half. And when you're looking at it, you can't then point out where the egg is in that chocolate chip cookie. It's a very important piece. You certainly need it. It will affect the overall texture and enjoyment of your cookies, but it's not something you can point out after the fact. And so that's how we think about who's in the White House and results of elections in terms of your financial plan. And so what we wanted to focus on just in this initial part, and don't worry, we will get to the portfolio and the resilience as you saw in the agenda, were just some sources of resilience that you have as an individual, that we all have, things that we can control in our lives when things like what happens in the markets and the economy are somewhat out of our control. And one of the pieces that you probably have heard at least Dave say in passing in your relationship with us is that, you know, at the end of the day, the president is not really that in control of the markets themselves and the economy. It really is, for the US, the 330 million people, all of us, everyone you know, everyone you love, going about our daily lives of earning, spending, saving, and investing. And those are the things that are in our control. And so whether that is maximizing your 401k contribution so that you get that free money from the match from your employer, whether it is saving to 529s for your children, your grandchildren, your nieces, your nephews, great nieces, great nephews, whoever you love and want to support in their college educations, whether it's determining the causes that you want to support while you're alive, or through your estate plan when you pass away, the people and causes that you would like to support as part of your legacy. Making sure you have the right types and amounts of insurance and that you're filling any gaps that you might have there, that you might see there. Changing jobs, determining employee benefits to best support your life, whether it's figuring out the right Medicare setup that for the insurance and drugs that you need in your life. Whether it's imparting the financial literacy that you have on your loved ones so that they can build their financial futures. There are so many pieces of your financial plan that build resilience into your life that really aren't affected by the outcome of a specific election. And at the end, kind of the big picture here is just really your live big life is the pursuit of your live big life is in your control. And so there are these many pieces of things, many pieces of your plan that are within your control and that are sources of resilience in your financial plan. Because again, in that financial plan that we're working on together with you, there's not a drop down, there's no assumption in there for who's in control of the White House. And so we just wanted to share that, again, while we will get to all of the fun and nitty gritty investment pieces, that, you know, we think of ourselves first and foremost as financial planners, and the investment piece and the economic piece and the political piece are one piece of your life. And there's a lot more there that can be talked about, focused on, and that we're happy to continue conversations on.
You're here. Well said, Lauren. And with that, our first chart of the day. We're going to talk performance for a few slides here. We've gotten a lot of questions recently. How's my portfolio doing? What's going on in markets? And so we wanted to show a few slides, first illustrating just what's been happening in this calendar year, 2024, year to date. If you've been watching the news recently, you know markets have been on a bit of a tear. They certainly were last week, given back a little bit this week, but I mean, let's just look at the top line there. The S&P 500 year to date is up about 27%. That's fantastic. The S&P 500 is included in every single one of our clients' portfolios. Leading the way across the top of the chart, you can see there, nothing has done better in this year, 2024, than companies in the United States, specifically large companies. You've got the S&P 500, which is comprised of 500 of the largest companies in the country. Value companies with a large designation, so companies priced a bit more cheaply than their counterparts, also doing quite well, up 20% year to date. Smaller companies performing well too, double-digit returns for both small and small value. And then the remainder of the investments in the portfolio coming from overseas markets, also in positive territory, just not performing quite as well as their domestic counterparts. And so we're showing, these returns are through yesterday, so they're current, or as current as they possibly can be. And so we wanted to bring that to the conversation before we continued with looking at some bigger or longer stretches of time as we go through our conversation today.
And I just wanted to point out for everyone attending, we are getting some great questions so far. I see them all, they're coming in, they're coming through, and we're going to get to all of these topics, so I'll bring them up when we get to those pieces.
Perfect, thank you, Lauren. This chart is showing you average annual returns for the period that we've noted here at the bottom of the slide. So since markets bottomed out during the COVID crash back in 2020, which, whether or not you find it hard to believe, was over 4.5 years ago. Over those subsequent years, these have been the returns that we've seen from the investments in your portfolio. So similar trend in that you're seeing investments in or companies in the United States performing better than those everywhere else around the world. But take note, while the S&P 500 has been gathering all the headlines and is averaging an annual return north of 25%, nothing to sneeze at. Our listeners or our viewers today, and if you've heard us in any previous webinars or you're a client of ours, we tilt our portfolio in favor of small company stocks and value stocks relative to the share they take up in the global market. And so we're always happy to see when small, or in this particular case, small value, are leading the charge. And that's been the case. Again, these are average annual returns since the bottom of the market in March of 2020. So US small value, better than 30% on average per year over these past several years. The same being true for US small, just shy of 30%. We mentioned the S&P 500 a moment ago, and there's US large value, they're just shy of 25%. Of course, international markets have performed well too, just not quite as well as what we've seen in the US. And you can see within the international segment, both of the value investments or the value funds that we carry in our clients' portfolios leading the charge on the international side of things. So good news all the way around. It's been a really fantastic run for stocks over the past several years, not without some bumps along the way, which we're going to talk about here in just a moment. But before we leave this slide, we'll just share two pieces. Each of these bars represents an asset class or a segment of our clients' portfolios. When you blend them all together, the Yeski Buoy portfolio has averaged, of stocks, the Yeski Buoy portfolio of stocks has averaged an annual return of 22.25% for the past 4.5 years. That's a full 1.5% higher per year than our benchmark, the All Country World Index. We will also share that our portfolio of stocks has lagged the S&P 500 by a few percentage points over the past few years. And so we're not going to shy away from that. Again, we own the S&P 500 within our clients' portfolios. It has happened to be the asset class that has performed best, and we're glad to see it doing well for our clients. This next slide picks out the two middle years of the stretch of time that we were just highlighting. So again, talking about returns since the bottom of the market in 2020, from the beginning of 2022 to the end of 2023, a 24-month period, we saw performance that looked very different from the two preceding slides that we just showed you. It's interesting to note the context. If you'll recall, in 2022, for the first 9 months of the year, markets were doing pretty badly, if we could just be blunt about it. We were dealing with an inflation problem. Inflation got up to as high as 9% that year, and markets ended up bottoming out in the latter part of September of 2022, and then started their recovery from there going on through into 2023, and 23 was a fabulous year. But what were the best performing asset classes over that 24-month period? The S&P 500 was in positive territory, absolutely. We're showing you here, by the way, total return. So negative in 22, positive in 23, total return across the 24-month period indicated by the bars you're seeing here. The S&P 500, again, in positive territory there in the middle of our slide. But what was ahead of it? Emerging markets, U.S. large value, international small value, international large value, and at the top of the chart, U.S. small value. And forgive me if the emphasis on value is a bit obnoxious, but we're trying to make a point here. In an environment where interest rates were rising, and rising at a rate faster than they had in recent memory, different parts of our clients' portfolios were performing better. And that's why we design these portfolios in this way. You're going to get resilience. You're going to harness growth from wherever it's emerging around the world. And so it's important to note that what buoyed the portfolio throughout these 2 years while we were dealing with this inflation scare were the value stocks, the small company stocks, the ones that we tilt our portfolio in favor of. And that ultimately led to the Yesky Buoy portfolio by way of total return outperforming the S&P 500. Why would that be the case? Again, as we just mentioned, value tends to outperform growth or more expensive stocks in instances where interest rates are on the rise. So we wanted to share those pieces, and then we're going to get into a really fun chart here on the next slide. But I'll pause. Lauren, are there any of the questions that have come in that we should address here and now, or should we continue?
I think next slide.
Well, and yes, go ahead. That's good.
So let's do this slide here, and we're gonna spend some time here. We're gonna be here for quite a while. What you're looking at is a 2-variable chart. The line in red, let me get my highlighter here. Line in red being your S&P 500. Excuse me, the line in red being your federal funds rate. And the line in green, kind of tracking along the bottom at first and then rising rapidly over the last 15 years, would be the S&P 500. So the federal funds rate, the baseline interest rate, that's been getting a lot of news recently because the Federal Reserve has been increasing that rate very aggressively to combat inflation. We're showing you some 35 years of that history of the federal funds rate. Why? Because we want to highlight how unprecedented this stretch of years has been relative to what we've observed over the past many decades. We should note, by the way, the gray bars on this chart indicate recessions. So we'll take you on a bit of a tour of history over the past 30, 35 years. Note that in the early 90s, the baseline interest rate was at 8%. 8%. we ended up, and that was after a stretch of increases, we ended up hitting a bump in the road and went through a recession in the early 90s. And you can see in response to that, that interest rate came down all the way to 3%. You can see the S&P 500 in those years in the early 90s rising at a nice rate. To start to combat what may have felt like a hot economy, interest rates started to come back up, kind of petering out around 5%. Hovering there for the next stretch of years until, in the wake of the dot-com meltdown that you can observe here, beginning in the early 2000s and stretching for a few years, the Federal Reserve, to give some relief to the economy, brought rates down fairly precipitously, all the way down to about 1%. They remained there for a bit, and then interest rates were rising again as the market and the economy recovered. On the rise, settling back again around 5% until we hit the Great Recession. And that's, of course, the widest bar that you see here, the most protracted recession that we all went through. And while it was some 15, 16 years ago, it still feels fresh in the minds of many, I would imagine. It was at that point that the Fed brought rates down to 0. And 0 is a piece that I think we really need to focus on, because you can see it's the first time on this slide, and the first time I think perhaps maybe in the entire period of modern policy as exercised by the Fed, that we saw 0% rates. And it wasn't just for a little bit of time. They remained at 0 for some 7 years. Note, by the way, that's when the S&P 500 chart went from linear growth to exponential. I mean, you can see the shape of the curve here if you're a fan of calculus. You can appreciate that this curve, or this part of the curve, is very different from the increases that we were seeing in the preceding decades.
And I just to interrupt,
please,
just to put an exclamation point over the sort of unprecedented Fed action during and following the Great Recession. The Fed funds rate, which the Fed sets and which the Federal Reserve sets, and which is essentially the rate that they expect banks to be charging as they lend each other reserves, is set explicitly by the Fed, but they actually made it without, they can't set a negative rate, except they did. They created, in effect, a negative rate by engaging in a thing that they call quantitative easing. So in addition to setting the Fed funds rate at 0, the Fed was aggressively out in the market buying interest-bearing securities, which was driving up the price and driving the yield down. So they were simultaneously setting a Fed funds rate at 0 and going out into the market and aggressively driving down market interest rates by buying hundreds of billions, and then even I'm not sure what the size of their portfolio is now, but I think it probably reached close to $1 trillion of securities that they acquired. So that was almost like creating negative interest rates, the way they were operating both in the markets and in the rates at which banks trade their reserves.
No, thank you, Dave. It's a brilliant point, and it's one that further underscores just how unprecedented this period of time was. And so recall that on a previous slide, we talked about how rising interest rates or higher interest rates favor value stocks or value companies, companies whose valuation is more concerned with near-term earnings for the next year, the next 2 years, the next 3 years. Whereas in instances where rates are at 0 or effectively in negative territory, so about as low as they can get, that kind of environment favors growth stocks. Companies who, when you're thinking about their valuation, you're looking way out into the future as far as their long-term expected cash flows. So many of those growth stocks are in the tech sector of the S&P 500. And so we've observed that particular sector of the S&P growing from 10, 12% in the early 2010s to at this point now a third by terms of weight of the S&P 500. It's not that 170 companies are tech companies in the S&P 500. It's actually that seven companies who happen to be tech companies are eating up some 30% of that particular index. And they benefited from two things. What we're describing as free capital, meaning they could access cash, they could gain capital or gain access to capital at, for most of the past 15 years, 0%, or as Dave just made the case for, negative interest rates. And in addition to that, we had this economic shock, a technology disruption. When I was in college, I graduated in 2009. I'll just share a quick anecdote. We were doing skits for incoming freshmen as part of the orientation leader class. And we were talking about Twitter as this novelty piece of technology, right? Tweets were cute. Tweets were a joke. No one was actually on Twitter, not like they are now. X, I should say, excuse me. But the way we interact with social media, the way we use the internet changed completely over this decade. And those companies, your Apples, your Amazons, your Microsofts, and so on, the ones that now make up the Magnificent Seven, capitalized on that technology shock. So you had two factors working in concert to create what has been observed as the longest secular bull market, the longest positive run for the S&P 500 in U.S. history. And so we wanted to really emphasize the role that interest rates played in this particular story, A, to contextualize what we've seen historically, but B, and perhaps more importantly, to describe how we think things are going to be different going forward. If we can spend just a bit more time in this segment here, you'll note that interest rates weren't at zero for the entire 15-year period. After those 7 years that we mentioned earlier, the Fed raised rates by a quarter point and then sat there for a bit. Then raised rates a bit more cautiously, trying to get up to somewhere other than zero. And as we were talking about in our run-through, preparing for this webinar, they got up to about 2% and unleashed what was at that point called a taper tantrum, right? They were tapering rates up and the markets flipped out. You can see this dip here. And subsequently started to bring rates down so as not to fall in line with kind of the reputation the Fed has of causing recessions by raising interest rates.
You will note, and this is true if we even had a bigger range than 1990 to the present, but ahead of every single one of these gray areas that represent a recession, you see rates going up. Historically, there's a really high correlation between the Fed raising rates and the economy going into a recession. And if you look in the left-hand side of this graph, you see that the Fed was, I don't want to say, they were a bit heavy-handed historically. The amplitude of these rate changes is huge. The Fed would decide that the economy is overheating and they jack rates up a lot. And then somewhat predictably, the economy would go into recession. They would drop rates. The cycle would start all over again. In recent years, of course, we had a very slow recovery from the Great Recession, and that kept those unprecedented rates low. But the Fed has more recently tried to be a little more balanced in their dual mandate of maintaining price stability and employment. So they have not wanted to, as they have in the past, create a recession every time they start to raise rates. And honestly, this narrow recession that represents the COVID recession had nothing to do with the Fed. It had to do with the worldwide pandemic. And so the current leadership of the Fed has actually done a much more nuanced job over the last 15 and 20 years than prior regimes have at the Federal Reserve. And we hope that continues. We hope the much sought soft landing continues to be our future.
That we do, and I'll make one more point here before we move forward to our next slide. You'll note that rates peaked after this most recent hiking cycle at just over 5%, and we've started to see some cuts, 2 cuts since then. In no way, shape, or form do we expect rates to come back down to 0. Unless there's some, again, as we were saying in our
cataclysmic global meltdown.
Right. Absent that, the Fed in part raised rates so high, not just to combat the inflation issue we were dealing with, but so that when they need to ease up or create some space in the economy, they can slash rates even by half and not come back down to 0, so leaving themselves some wiggle room. So what does a different interest rate environment mean for your portfolio? We'll talk more about that in a couple of slides. But for now, we're going to move off of the Fed and interest rates, and we're going to talk about the results of the election.
Yusuf, let's actually, before we move off that, have a couple questions that I think play in well here. One of them was about what this interest rate environment means going forward. So we will get to that, and we'll talk about that for sure. But one specific to current inflation, we had the announcement of inflation, the October inflation report, 2.6%. And so question here, and this, you let me know if you think this is better for what the ongoing interest rate environment section. But what does that mean? Is it going to help, hurt, or have no impact on our Yesky Buoy investments is the question.
The inflation being at around 2.5%?
Yes.
Well, personally, 2.5% doesn't scare me. The Fed's target is 2%, and they've noted that they're going to let that kind of swing and hover around 2 before they take, specific action. So I think, 2.6% is fine. I'll note in the financial planning projections that we build for our clients, we assume 3% inflation for our long-term projections. So,
and it's true that I was going to say, it's true that 2.6 is a slight tick up. The last number I think was 2.3, but we don't feel there's any reason to worry that 0.3% move represents a new trend.
Right.
I actually, the Federal Reserve does not share with us what their future plans are, but I don't think that by itself is going to slow the general trend towards the Fed lowering rates closer to probably about 2% in the end.
Yeah, and so there's one other question that I think actually we'll keep on this slide for a second, but I think it will lead us really nicely into the next portion of our discussion. Just Dave, when you were sharing about quantitative easing back in the Great Recession and decisions being made, by parties in power at that time, and I think that there were similar occurrences in the COVID downturn. There was significant fiscal stimulus that was decided on by the White House, by the government to help. And so while the Fed is, we're looking at the Fed funds rate and the decisions they're making, there are also aspects of government coming in at certain times and making decisions. And so the comment was, well, then maybe who is president does actually matter and does make a difference. And so I think maybe some commentary on the difference between, ongoing market expectations versus these were 2 major events, the Great Recession, a global pandemic, and government stepping in at that point.
And I'll just say, I think the key here is the independence of the Federal Reserve. The Federal Reserve, when it was first created now a century ago, was designed to operate independently of the executive branch or the legislative branch. And it doesn't mean that the legislature and the executive couldn't change things. Legislation could be passed that changed the way the Fed operates. But as currently constructed, the Federal Reserve is, at least in principle, operating as an entirely independent entity, and it has its dual mandate of price stability and high employment, and politics is not part of its mandate. And I'm not going to say that over the last century, Federal Reserve chiefs haven't from time to time been influenced by politicians, but by and large, they have operated independently. The current Federal Reserve leadership under Jay Powell absolutely has operated independently. And in fact, I'm sure you all saw the news items reporting that Powell's on record least with some people, saying that if President Trump asks him to step down, he's not going to do it. He's going to serve out the rest of his term. And so I don't think that's going to become a fight. I don't think anyone's going to want to make that a fight. But the Fed has operated very independently. I have every reason to believe they're going to continue to operate independently. And so I don't think that's going to be a source of instability. If it's going to come at all, it's going to come through Congress and the White House. And we think there were significant limits on what they can do in any case, or what significant limits on what they're likely to do. But we'll get to more of that in a few minutes. But the bottom line is that in answering that question, the independence of the Fed is the key factor here. And we have every appearance that the Fed leadership intends to remain independent of politics.
Next slide. All right. So Donald Trump will be president again. And there's been no shortage of news about potential policy implications. So we're going to go through, I think, 4 different segments here. The first one being tariffs. And let's talk first and foremost fairly about how when Donald Trump was last president, he imposed tariffs in various spaces. And the Biden-Harris administration continued many of those tariffs throughout the last several years. And had the outcome of the election been different, it's quite likely that a number of those tariffs would have continued out into the future. And so the reason we're talking about tariffs today is not because President Trump would be introducing something new to the geopolitical landscape. It's that some of the rhetoric on the campaign trail has been about 100% tariffs.
On everybody.
On everybody, which
Yeah.
may or may not come to pass. So we wanted to make space here. Dave, I'll invite you to jump in and just make a couple comments if you'd like before we go to the next segment.
Well, many of the tariffs that were continued under the Biden administration were significant tariffs that were placed on Chinese imports. And while there were tariffs in other industries, there were steel tariffs imposed at one point that influenced countries other than China. By and large, that was where the biggest tariffs were found, and that was where the tariffs were maintained by the Biden administration. It's hard to imagine that, notwithstanding the rhetoric of the campaign trail, as you put it, that President-elect Trump and his administration will push for tariffs across the board. That could create some dislocations. That would have a macroeconomic effect, and we're in a wait and see mode there. But honestly, the effect of the tariffs to date that were started, back in the mid-teens, if you just look at a chart of the economy and the markets, and not just the U.S. economy, the global economy and the markets, you can see that those tariffs, while they made Chinese goods more expensive than they had been previously, they didn't really change the trajectory of the economy or the markets.
Right. Well said. Continuing with the economic trend, we'll talk about trade wars. We've heard the phrase come up a lot over the past year. When we think about gross domestic product, which is a measure of economic output, and the one most frequently cited, net exports, so whether or not a country imports or exports more, net exports in the positive sense contribute positively to gross economic output. Trade wars directly impede the effects of having a positive trade balance. And so whether or not the United States ends up engaging in a trade war with any other country, we won't know. Again, as Dave, you were saying a moment ago, we're kind of in a wait and see mode. Would we expect them to contribute positively to economic output? No, not based on the math. But again, Dave, as you were mentioning again, tariffs that were imposed almost 10 years ago at this point, didn't seem to have a negative output or negative effect rather on the economy or markets. And so again, although there may be consternation around this particular subject and any potential policies that may come up in the coming years, again, we're in a bit of a wait and see mode.
Yeah,
Oh, go ahead, Dave.
no, I was just going to say, I was looking at some of the questions that were coming up. Jack just had one, but I think that one of the things that we can take away from what we've seen historically over the last decade with the big increase in tariffs on Chinese goods, some increase in tariffs on other goods with other trading partners, seemingly having so little impact. It comes back to one of the sources of resilience that we have talked about and will continue to talk about, and that is the fact that, you know, within the U.S., more important than decisions coming out of Washington are the daily decisions by the 330 million residents of this continent or of this nation, going about the daily business, as Lauren said, going about their daily business of earning, saving, spending, and investing. And they're living their, you know, human beings are living their lives. And they're living their lives in ways that have to do with their own needs, their own happiness, the needs of their families. And that's how they're going to organize their activities, their earning, saving, you know, their earning, spending, saving, and investing activities. And the same thing is true of 7 billion residents around the world. You know, the thing is, you have 7 billion human beings going about the business, you know, basically sticking to their own knitting, going about the business of running their lives for themselves and their families. And that tends to have a huge sort of, what do I want to say, a bumper or cushion effect for any policies that come out of the US or any other country at the top political level. Those things have a measurable impact, but it's not, by far, it's not the biggest impact on what's going on in the economy, not on average. And again, this is, you know, human beings are resilient, and they're especially resilient collectively in the aggregate.
Here. The next topic we wanted to make a couple points about would be immigration, and something we were discussing in the run-up to this presentation was.
We actually had a word.
I'm
going to interrupt you, so just to say,
please.
We actually changed. We had a word here that said deportations, and I know that someone had asked a question about deportations, mass deportations, and we thought immigration would be a less charged term, although deportations are an element of immigration policy, so it's all there. Anyway, I'll carry on, Yusuf.
No, it's just that we had agreed amongst ourselves that regardless of how you voted or which side of the aisle you may land on, I think we can all agree that our country's immigration policy is not perfect. Might we see policy changes in this particular area in the coming years? Perhaps. How they might affect things in the economy, yet to be seen. We do know that if we are getting questions about mass deportation, if that were to come to pass, it could create some serious dislocations in as we measure employment. And that could have implications for inflation, just because we know that if companies are competing for fewer employees, that would suggest they might end up paying more for those employees to gain them as employees of their particular company. But again, it will be something that we will be observing and watching diligently. But for now, again, we're just waiting to see what we'll see.
And it's not the kind of policy changes in that area are not the kind of things that can unfold overnight. I mean,
right.
So it's the kind of thing we're likely going to be in a position to monitor and evaluate. But again, while the impact is, you know, while there are potentially measurable impacts to the macroeconomy, we don't think that's a big enough factor to actually require any action at this time.
So Yusuf, I have three, we'll see if more come in, but I have three questions that I think fit really well with the three things that the two of you have shared so far on this slide. And then Jim is here reading minds, knowing what the next topic is already. So, but just a couple questions here about these things in the stock market. And so the first one being, with these proposed tariffs and this potential loss of significant migration and migrants in our in our country, how can the market be so exuberant?
Oh,
I just want to remind everyone, by the way, that if you were afraid of Trump in 2016, we had a lot of conversations with clients who said, I don't know, he seems like an agent of chaos. If he's elected, we need to be in the sidelines. And his immediately after the first time he was elected, the markets went up. And immediately after his re-election, last week, the markets went up. And people have explanations. People have explanations for this that cover a lot of territories. Like, well, there'll be less regulation on companies, and therefore they'll be more profitable. Maybe corporate taxes will go down. They're anticipating that some policy changes might benefit companies. Personally, I also think a not insignificant element of that may be that it was just a big sigh of relief. Okay, for better or for worse, we know what the near-term future is going to look like, and because markets don't like uncertainty more than anything else, they don't like uncertainty, and that's all they deal with every day because markets are future focused and the future is unknown, and so the results of last Tuesday's election created a lot less uncertainty. Whatever you think of the outcome, there was a lot less uncertainty.
So the next one, related question, just the stock market is going up and the bond yield is going up. Is there a relation there? Is there a connection? Why are both of those things happening?
Well, they can happen in concert. I mean, there's so many variables that influence both. And so you have investors on both sides of that particular aisle, if we want to divide stocks and bonds, that are making assessments about where they think things are going on a forward-looking basis. And so there's an expectation that interest rates maybe could be going up, and there's also an expectation that stocks are going to perform well going forward. And we're seeing both of those things play out right now.
Yeah, and if I mean, supply and demand is a major driver in financial markets, and if investors are becoming more optimistic about stocks and they're selling bonds and buying stocks, well, when you sell bonds, it drives the price down and drives the yield up. And then, of course, if that money flows into the stock market, that drives prices up. So, there's a supply and demand equation that would fully explain that. And it just involves investors moving their money from bonds to stocks, selling bonds and buying stocks. When you sell bonds, rates go up.
We've got some other good ones coming in, and some that are on similar wavelengths. So I'll try to ask them kind of combined. It's just, some of the original questions we got right when we logged in was there's fear. There's fear of the uncertainty. We were talking about it yesterday with someone. There's just so many unknowns, so much uncertainty around what has been talked about, and we'll talk about it in the bottom right section, which is tax policy. We don't have to keep it a secret. We'll talk about taxes in a minute. But so much uncertainty around what's been promised, what's been, campaigned, what could actually happen, and the potential for just disruption in our lives because of politics, fears of instability in the markets or in the country as a whole, and worries about these things, inflationary pressures. So maybe Dave and Yusuf, you speak a little bit to, and one of the other pieces, I apologize, one of the other pieces was just looking at how can we look at history when Trump is promising to kind of change everything, change the world as we know it. And so maybe the two of you could speak a little bit to, what we know, what we believe, and then how we deal with that uncertainty.
Yeah. I'll make a comment that's maybe going to come off a bit trite, but it's rooted in a ton of evidence. Changing the world overnight is a tough job. There are a lot of things that would have to come into play to make that statement true. So changing the world as we know it overnight or in a year or in 4 years would require unprecedented things to occur. And I'm going to skip to the next slide just for a second to make a point, not the point that we intended to make, but There's a reason why our clients' portfolios are designed such that they're invested everywhere. We want resiliency in the form of diversification by way of investing in asset classes up and down, left and right, international, US, large, small, value, growth, it's all there. No matter what happens, this is a portfolio that's designed to perform and perform well. And it's built to be resilient, irrespective of what unfolds in markets, economies around the world. So I'll maybe save that as my opening statement and maybe turn it over to you, Dave, if you'd like to contribute or add more there.
Yeah, I mean, I know several of the questions I think use the word unprecedented, and I will admit that a lot of the rhetoric has been unprecedented, but we have this kind of messy political system in the U.S. And of course, you could look all over the world. You can look at Europe and Japan and everywhere else, and their political systems are equally messy and unpredictable. But the thing about the messiness and all the checks and balances, between the House and the Senate and the Supreme Court and the White House, and then you have to throw in 50 state legislatures and 50 governor's mansions, and you end up with this federal system that is, it's a little bit like, the Queen Mary. It does nothing turns on a dime. It's true for, we've talked about tariffs. It's true that the White House can impose tariffs quite quickly. But in most other regards, in the case of most other major macroeconomic changes, there's a slowness to the process that was really by design. If you look back if you read the Federalist Papers, and if you look back to how our system of government was designed 300 years ago, you find that the founders, they were highly suspicious of the potential dark side of government, and therefore they built a system that had so many checks and balances in it that it slowed everything down. And I think that's one of the things that maybe we're going to have to just hang our hats on going forward, is that one person or one group of people can say anything they want to say, and no matter how outrageous it may be, but the system itself, the system of government, including 50 states in our federal system with their own governments, are going to make the process slow. And if you're hoping for change, sometimes that can be frustrating. If you're fearing change, that should be a source of comfort. But I think that's the fundamental takeaway for me, is that our system is slow. We all fear that someone's going to figure out how to take shortcuts. I'm skeptical that too many shortcuts are available to any decision maker in Congress or the White House. I think our big, sprawling, messy federal system is going to be a source of stability, because it's so messy and it's so slow.
So I'll jump in now on tax policy. We had a question about it. It's something certainly that was big on the campaign trail and is always big in everyone's minds. Maybe mine most importantly, because I am a resident tax nerd, love the tax planning piece. And it's a question that's coming up. What's going to happen? What are the tax changes going to look like? And so, similar to Yusuf, what you were sharing about the tariffs, we are still, and I think this is something that people don't always remember, we're still under Trump's 2017 TCJA, the Tax Cut and Jobs Act. And so those were the tax cuts that Trump enacted during his first term, and they are currently set to sunset at the end of 2025. So for those of you listening who are in California, theoretically, your $10,000 state and local tax deduction should sunset. I'll talk about that in a second. The reduced income tax brackets are set to sunset. And another big one that we've been having a lot of conversations on is the estate tax exemption, which is currently over $13.5 million per person, is set to sunset back to 50% of that per person at the end of 2025. Now, A couple weeks ago, we could have had a lot of conversations around what might happen. There were a lot of things that Trump was talking about and potentially promising on the campaign trail for even greater tax cuts for businesses, for individuals, no tax on Social Security income, reduced taxes for first responders, a lot of things that he was promising and saying that he would enact pretty soon in office, while at the same time talking about the budget and the deficit. And so when we think realistically about what might happen, you know, my gut sense is that we probably are looking at a continuation of the Tax Cut and Jobs Act. So kind of staying where we are today, continuing those lower income tax brackets for your tax return you're filing in April every year, continuing, unfortunately, that $10,000 state and local or SALT cap, continuing those higher estate tax exemptions. And the reason for that being that's going to be a really easy thing for the government to get done. So similarly, Dave, to what you were just saying, it's not easy to make these major changes overnight. And as somebody who has been following along with all of the tax law changes throughout the last at least 5 years, because we've seen so many of them that came through in COVID as well as part of that fiscal stimulus, it takes a long time to figure out all the pieces and what other members of government are actually going to agree to. And so I was reading an article this morning about some of these tax law or tax policy changes that Trump has been talking about on the campaign trail, and that there are Republicans in his own party who are maybe a bit more deficit concerned than he may be, or than others may be. And so it is likely going to be pretty hard to get through additional major tax cuts on top of what we're already living in with the Tax Cut and Jobs Act. And something that I meant to say in my first slide at the very beginning, and I know Dave has said and Yusuf has said all along, it's something we're watching like a hawk. You know, I am constantly watching what's happening. We will be paying attention to any proposals that come out, to, of course, anything that gets passed, watching what's going on, whether it is a threat to our clients or an opportunity for our clients, and then actually diving in and doing the analysis for each and every one of our clients and looking at what is changing. Does this affect you? And if so, do you need to act? And even if you don't, reaching out and saying, hey, we already thought about you. Here's what the changes say. You don't need to act, and here's why. In addition to more webinars, so webinars on any tax policy, estate planning policy, any other policies that are coming up that are going to affect you or the investments or our portfolios. And then ongoing articles in the Live Big Way Digest. So it's something that while we certainly don't know what's going to happen, and I may not personally expect major change in that category, I will be watching it, and you will hear from me the second there is any update.
And the thing I'll add to that is that, you know, sometimes, pardon me, we've occasionally had questions from some of you who are clients about why we ask for so much information, and we're parsing so much information about your financial life and extracting key elements and posting on your client private page. And the reason we do that is that if we don't have a full picture of your financial profile, it's harder for us to be proactive and say, oh, something has just changed. Congress has just passed some new legislation that's going to affect certain people. We need to be able to identify if you're one of the people and if it's a threat or an opportunity and which action should be taken. So when we ask you for data, it's not because, I mean, sometimes financial planners have a propensity for just liking data for data's sake, but we're really doing it for a reason. And I'm going to pop back just for 2 seconds on my prior comments about the stickiness of government. It's important to remember that while the Senate is now in the control of Republicans, they only picked up 3 seats. They have a 3-seat majority, and the filibuster is still in place. And even if the filibuster went away, it's hard to imagine that any extreme actions that the White House might propose couldn't find 3 Republican senators who might object to it. So this is like, that's going to be another mechanism for slowing down anything that might be a radical change.
And I'll just make one final comment on the tax policy piece. Of question came in, but will TCJA, that's again the Tax Cut and Jobs Act 2.0, be exactly the same as the 2017 version? We don't know. As soon as we know, I promise I'll write a whole article about it. I will be reading and utilizing experts who read every single word of the policy. You know, I think from a thought standpoint, it certainly would be the easiest thing to get through It's already in place. Everything's in place. The code is in place with the IRS. All of the tax preparers know everything going on there. All of the political players know all the pieces of what we have lived under since 2017. So it would be the path of least resistance to get that through, if Trump thought he had the support to do so.
So with that, we'll move quickly. I think past this slide, we've already addressed kind of the main point we wanted to make, and we can end here with what lies ahead. What are we going to be doing? And we've been touching on this in response to some of the questions that have been coming in. I'll make the point clearly of what we will not do. We will not be making reactive changes that aren't based in evidence. At the end of the day, we're fiduciaries. And so the way that we have to act in service of our clients advocates, that we have to be mindful of what the evidence suggests should be done, and then take action in a way that supports that, just to make sure that we're doing things the right way. On the other end, what we will do is a much lengthier list.
So we will remain vigilant and diligent. So as I was just sharing, and as we've spoken about throughout this webinar, although we don't think who wins the election necessarily affects your portfolio or your financial plan in ways that it feels like it might or felt like it might before this webinar, it is part of our lives, and it is something we are paying attention to constantly, and will continue to do so, no matter what time of day it is, or what day of the year it is, or what year it is. Election years, non-election years, we're always paying attention to what is coming out of Washington and how it affects you. Some things that we will continue to do: reviewing portfolios biweekly for rebalancing opportunities. So internally, this is called our 2-week look, something that we spend a lot of time on, making sure that we're constantly reviewing every client portfolio every 2 weeks and making sure that when there are rebalancing opportunities subject to our policies and our evidence-based and research-based policies, and then the human dimension of making sure it makes sense for you specifically, that those rebalancing trades are made. We are also knee-deep in year-end tax planning. So that's everything from looking at Roth conversions and whether that makes sense in low-income years, making sure that your retirement account contributions are done for the year, or that your required minimum distributions and qualified charitable distributions are done before that 12/31 deadline. So that's something we've got a bunch of our financial planners on this webinar today too. We're all knee-deep in those analyses, and we'll continue to do that. We will, as I just said, monitor tax, estate planning policy proposals and other relevant developments that are coming out of Washington as things change and as we go into next year and the next 4 years, what is happening and what it means for you specifically, and then making sure we're connecting on that so that you know whether you need to take action or whether it doesn't directly affect anything you need to do immediately. And we will always continue to maintain our grounded policy-based approach to decision-making. That is something that is core to who we are and what we do and why we do it, and really important for us as a leadership group and what the decisions that we make that affect the business and that, of course, affect you directly in the work that we're doing together. And on that note, as always, we remain available for all your conversations. So I know there are a few questions that we did not get to that were a little more nuanced or not specific to the exact topics we were talking about. I've got them all here. We will reach out and answer those. If you have additional questions that come up as you're watching this, or if you're someone watching the recording after the live session, send us your questions. We are happy to, as you might imagine, talk about this. We love what we do and we love talking about this. Be careful what you wish for, though, because both Yusuf and Dave are known to give the long answer to the short question. And we remain available for updates to your specific financial plan. So again, a reminder that your financial plan is about you. It's about so much more than one piece of your life. It's about the entirety of your life, your values, what and who matters to you. And as your life changes, or as policies come out that affect your plan directly, we'll talk about it, we'll update your plan, and we'll get together.
And with that, thank you for joining us. We had a fantasy that we wouldn't go over an hour, and that was, in fact, just a fantasy, but it was partly driven by all of the wonderful questions you had. And as Lauren said, we will respond to every question that wasn't already addressed in the webinar. And any others you come up with, just call us or send us an email, and we'll get to those as well.
Thank you all.
Yes, thank you for being here.